Hello everyone, welcome back to another video. Today we're going to be covering the Chapter 6 questions from the Investment Banking Valuation, Leverage Buyouts, and M&A 2nd edition textbook by Joshua Rosenbaum and Joshua Pearl. Now, I've already released the Chapter 6 comprehensive video covering the sell-side M&A business, and so that's really what Chapter 6 covers. It's much more theory-based. In Chapters 1, 2, 3, and 5, we cover the comparable companies analysis, the precedent transactions analysis, the discounted cash flow model, and the LBO model. Now, that technical side is covered early on in the textbook. Later on in Chapters 6 and 7, we're looking more at a more theoretical perspective and kind of procedural perspective of both the sell side and buy side of the industry. And so in Chapter 6 is the sell side of the industry, and the video is quite long, but it does provide a comprehensive overview of the sell side industry for anyone interested in getting into the investment banking industry. And then in Chapter 7, when I do release that video, that will be the buy side industry in covering the different steps that a buy side investment banker needs to do in order to complete the acquisition of whatever goal they want to meet for their client. So let's get started. So question 1, which one of the following is not a potential weakness of an auction process? A, information leakage. B, collusion among bidders. C, employee morale might be negatively affected. And D, the likelihood of leaving money on the table. So which of the following is not a potential weakness of an auction process? Well, information leakage is a potential weakness, especially if you're opening up to a broad auction. There are a lot of bidders, you're offering confidential information to a lot of people, and that can, of course, leak. Collusion among bidders is also a real risk. Employee morale might be negatively affected, while the likelihood of leaving money on the table is not a risk. With the auction process, when you're creating that competitive bidding environment, you're driving up the price of the business. Therefore, you're not really leaving money on the table. With a negotiated sale, when you're only dealing with one bidder, that's where you leave the money on the table. So D would be the answer. An auction process is a staged process whereby a target is marketed to multiple prospective buyers. Potential drawbacks of an auction include information leakage into the market from bidders, negative impact on employee morale, possible collusion among bidders, reduced negotiating leverage once a winner is chosen, and taint in the event of a failed auction. Question 2. The advantages of a broad auction include 1. Limiting buyers' leverage. 2. Preserves the likelihood of confidentiality. 3. Ability to approach all possible buyers. And 4. They give board of directors confidence if fulfilled its fiduciary duties. So the advantages of a broad auction, which essentially means opening up the sale of the company to as many bidders as possible. Well, are you limiting the buyer's leverage? You kind of are, because again, that means that you have all these multiple buyers, and therefore the leverage the buyer has in kind of imposing their bid upon the seller is much less, because you have a lot of bidders. So 1 is correct. 2, preserves the likelihood of confidentiality. That is not true. That's a disadvantage of a broad auction. So 2 would not be correct. 3, the ability to approach all possible buyers. That, of course, is correct. It would be 3 as well. And then 4, it gives the board of directors confidence it fulfilled its fiduciary duties. Well, the board of directors represents the shareholders, which represents the maximization of shareholder value. Therefore, with a broad auction, you're maximizing shareholder value by driving competitive bidding. Therefore, 1, 3, and 4 would be correct, while 2 would be wrong. So the answer would be 1, 3, and 4. So it would be B. So preserving confidentiality is not an advantage of a broad auction. In a broad auction, the target is marketed to numerous strategic and financial buyers to maximize value, which typically results in information leakage, heightening competitive dynamics, and thus enhancing the probability of achieving a maximum sale price, which is the ultimate goal of an auction process. Question 3. The potential disadvantages of a targeted auction include all of the following except A, the potential to exclude certain buyers. B, the greatest risk of business disruption. C, not maximizing competitive dynamics. And D, buyers have more leverage. Well, with a targeted auction, essentially you're choosing a few bidders that can be included in the bidding at the auction. Whereas with a broad auction, you're expanding it to anyone who really wants to bid. So the greatest risk really is not maximizing the competitive dynamics to drive up the price, right? So that is a potential disadvantage. The potential to exclude certain buyers is a potential disadvantage, and the greatest risk of business disruption, that is not a disadvantage. So business disruption is not a key risk in a targeted auction, whereas with a broad auction, it's very public, and that can hurt business. So it would be B. The greatest risk of business disruption applies to a broad auction. Other disadvantages of a targeted auction include potentially leaving money on the table and providing board of directors with less market data they can use to make certain they achieved maximum value. Now, question 4, which of the following is the least important criterion when evaluating strategic buyers? A, the M&A track record of a buyer. B, an LBO financing package. C, cultural fit. Or D, a strategic fit. What is the least important? Well, LBO financing package doesn't really matter. You care about the M&A track record. Have they really acquired previous companies in the past and how that has worked? Cultural fit is incredibly important, and so is strategic fit. So B would be one that is not very important. Now, question 5. Which of the following is least relevant when evaluating potential sponsor buyers? A, number of partners at fund. B, the fund size itself. C, the investment strategy. And D, a sector focus. So what is the least relevant when evaluating potential sponsor buyers? Well, these sponsor buyers, financial sponsors, are typically hedge funds or private equity funds. And the fund size is very important to see if they can afford the transaction, the company. The investment strategy is incredibly important, and so is the sector focus. But the number of partners is not very important. So A would be the answer. When evaluating potential financial sponsor buyers, key criteria include investment strategy focus, sector experience, fund size, track record, fit with an existing investment portfolio, the fund life cycle, and the ability to obtain financing. As part of this process, the deal team looks for sponsors with existing portfolio companies that may serve as an attractive combination candidate for the target. Question 6. Which of the following are the 2 main marketing documents for the first round of an auction process? A, a teaser and confidentiality agreement. B, a teaser and a CIM. C, a teaser and a bid procedures letter. Or D, a bid procedures letter and a confidentiality agreement. So if you haven't watched the Chapter 6 video, probably some of these terms you won't really understand. But the answer is B, the teaser and the CIM. The 2 main marketing documents for the first round are the teaser and the CIM. The teaser is a brief 1-page synopsis of the target, and it is the first marketing document presented to prospective buyers. The CIM is a detailed written description of the target, often 50 plus pages, that serves as the primary marketing document for the target in an auction. Question 7. Which of the following is not included in a typical teaser? A, company overview. B, a detailed financial section with MD&A. C, investment highlights. Or D, contact information of sell-side buyers. Well, with a teaser, you really just want to spark buyer interest to really engage them for them to then sign the confidentiality agreement so that they can then show further information, right? Because it's important not to release too much sensitive information early on in the auction process. And at the same time, from a legal perspective, you don't want to put the company in play. You just want to provide this information to the buyer to see, are they interested in what the company has to offer? So B would not be part of a teaser, a detailed financial section. That's too much sensitive information. That's for later on. That's provided in the CIM. So B. So question 8, which entity might cause sell-side investment bankers to create a modified version of the CIM? A buyer who is public. B, a buyer who is a competitor. C, financial sponsors. Or D, international buyers. So one of the risks with a CIM, and the reason why, in the auction process, early on you sign a confidentiality agreement is because with the CIM, you're sharing detailed information and detailed projections from the management about the company. So you want to modify that when it comes to a buyer who is a competitor, B, because with a competitor, they learn about their competitor and they learn about how they view the business, how they view the growth of their stores or their products or their services, right? And so you want to make sure that you're tailoring it enough that they still provide enough information to engage their interest, but at the same time, you don't want to offer them too much, because if they just walk away without offering a bid, then all of a sudden you just open up the business to them and they learned about the business and they just walked away, and now they're better equipped to plan around your projections. So it would be B. So a modified version of the CIM may be prepared for designated strategic buyers, namely competitors, with whom the seller may be concerned about sharing certain sensitive information. Question 9. Are potential acquisition candidates included in a CIM? A, yes, and occasionally, yes, in a modified version of the CIM. C, always, or D, never. Now, really, the answer would be yes, and sometimes occasionally. In some cases, the CIM provides additional financial information to help guide both strategic and financial bidders towards potential growth or acquisition scenarios for the target. And it's much more relevant for private equity firms who are going to look at that company, look at the current free cash flow potential of the company, and then look at potential acquisitions to increase and leverage that free cash flow to further pay down debt. So in certain scenarios, especially for CIMs sent towards private equity financial sponsors, yes, that is a potential option to include in the CIM. Question 10. Which of the following are typically included by buyers when they submit a bid during the first round of M&A negotiations? 1. Assumptions to arrive at the purchase price. 2. The purchase price. 3. A future role of target management and employees. Or 4. Key conditions for signing and closing. Well, really, as with anything, to really communicate the seriousness of their bid, it would be all 4 of them. All of the answer choices are typically included when buyers submit a bid during the first round of M&A negotiations. In addition, the bid may include structural considerations, information on financing sources, required approvals, and timing parameters. Question 11. Stapled financing refers to what? A bidder evidence of committed financing. B, a prepackaged financing structure often offered by the sell-side investment bank. C, using only term loans in the financing structure. Or D, using only fixed interest debt instruments. Now this, if you watch the Chapter 6 video, is a relatively easy definition. Stapled financing is B, a pre-packaged financing structure often offered by the sell-side investment bank. So stapled financing is when the investment bank running an auction process offers a pre-packaged financing structure, typically for prospective financial bidders, in support of the target being sold. While buyers are not obligated to use the staple, it is designed to send a strong signal of support from the sell-side bank. And usually what potential bidders do is they take that stapled financial package and they go to other commercial banks, other lenders, and they look, this is what we have, can you do better, right? So it's a great material to both to communicate a strong signal of support from the sell-side advisor, but at the same time for the bidder, it offers them a reference, a benchmark to what it would cost them to complete the deal. Question 12. All of the following are included in a final bid procedures letter except A, evidence of committed financing. That's very important and it's required in the final bid. B, a purchase price presented as a range. No, because the thing is, in the initial bid procedure letter, in the first round of the bidding process, the potential bidders set a range of the valuations they could offer. But in the final bid procedure letter, you want to set a certain number. You're not going to give a certain valuation range like 7 to 10 million. You're going to be like, I want to buy this business for 7.5 million. And you define that certain number. So really, B would be the answer. That is not part of the final bid procedure letter. So while presenting the purchase price as a range is common on the initial bid procedures letter, on a final bid procedure letter, the purchase price must be presented as an exact amount. Other elements of a final bid procedure letter include a markup of the draft definitive agreement, attestation to completion of due diligence, and board of directors approvals. Question 13. A material adverse change blank results in, it allows the competitive bidders to re-enter the process. B, it could permit a buyer to avoid closing a transaction. C, it allows the government to block a transaction. Or D, it mandates regulators to block a transaction. Well, the answer would be B. With a material adverse change, what can happen is, say for example, the business all of a sudden gets hit by a hurricane. And all of a sudden, all its operations is just destroyed. It's going to cost billions of dollars to build up the stores and, the headquarters and all that kind of stuff. And so if a potential buyer is in the second round of negotiations and they're just, they're ready to complete that transaction and they see this, all of a sudden, they're left holding the bag, right? But with material adverse changes, they can walk away. Right, so MAC, or material adverse effects, and MAE is a highly negotiated provision in the definitive agreement, which may permit a buyer to avoid closing the transaction in the event that a substantial adverse situation is discovered after signing or a detrimental post-signing event occurs that affects the target. So question 14, who is typically hired to render a fairness opinion? So a fairness opinion is a objective analysis of the proposed transaction that the board of directors uses to show to shareholders and say, look, the transaction and the bid that we agreed upon to present to you is considered fair based on this financial advisor's analysis, right? And so the answer really, it can be both the investment bank who's serving as a sell-side advisor, as well as in a third-party investment bank who's not serving as a sell-side advisor. So it can be one and two, right? Because a corporate law firm does not have the experience to analyze it from a financial perspective, while a consulting firm does not have that experience to really understand the deal. So it's one or two. So it would be A. So historically, the investment bank serving as the sell-side advisor to the target has typically rendered the fairness opinion. In recent years, however, the ability of the sell-side advisor to objectively evaluate the target has come under increased scrutiny. This line of thinking presumes that the sell-side advisor has an inherent bias towards consummating a transaction when a significant portion of the advisor's fee is based on the closing of the deal. And that's why they introduce a third-party investment bank in order to render that fairness opinion. So it depends. So it would be 1 and 2, A. So the final question, question 15, if more than blank of an acquirer's pre-deal common shares outstanding are being offered as a form of consideration in a transaction, the acquirer needs to obtain shareholder approval. So how many percentage of the acquirer's pre-deal common shares need to be offered in the form of consideration for them to require shareholder approval? Well, again, if you watch the video, the chapter 6 video, which I do recommend you watch, you'll know that the answer is C, 20%. So 20% of pre-deal common shares being offered in a deal is the threshold that requires the acquirer to get shareholder approval. That's pretty much it. As always, if you did enjoy the video and you found it helpful, please like and subscribe to the channel for more. If you have any questions, I do recommend that you comment below, and I'll be sure to get back to you as soon as possible. As always, guys, have a great day.